It was a tough day for the U.S. stock market with the S&P 500 down about 2% here today. We found that only 13% of stocks in the S&P 500 closed in the green, and the vast majority of those were from one single sector, and that sector was energy. Oil and gas did have a nice snapback rally here today, but pretty much all other stocks closed in the red, so it was a very broad-based sell-off. Of course, this comes after about a week and a half of buying and optimism, and is a fresh reminder that the path of least resistance for this market is still to the downside. So we'll take a look at all of that, see what it means for our posture. Then we'll get into our trade application example where I wanted to feature a very liquid tech stock with what's known as a bear call spread. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 28th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the video's description area and make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. At the bottom of those emails, you'll also find which stocks are giving you overbought and oversold cluster signals within the S&P 500. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee, and we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And it was another lousy day for the markets. Kind of still feels like we're in this mode of two steps back, one step forward, right? We've had that step forward here over the past, week and a half or so, but that hasn't changed the trajectory of this market. The trajectory of this market continues to be to the downside, which is, why I've mentioned to you, and I'm sure David has as well in his presentations, that I don't think either one of us are expecting to get back to new all-time highs anytime soon, and I doubt that either he or I expect that the low that was printed a couple of weeks or a month ago, whenever it was, will be the low. My own personal thought is that we will probably be stuck in a bit of a range with a slight tilt to the downside for the better part of the next year. So brace yourself. These things usually do not blow over very quickly. That's what made the whole, COVID crisis so unique, in that it went down so rapidly, but then immediately rebounded just as rapidly. That is not normal at all. Most market pullbacks throughout history, at least significant ones, do last a long period of time. I usually put the time frame of about 18 months in the back of my head, which means we could still be at this for another year with difficult conditions. And so you want to do your best to survive during these market environments and know how to trade both sides of the ledger, which is why we show you bullish and bearish trades so often during these presentations here. So, we'll see. There's always the possibility of some unknown benefit that could inspire the markets down the road. I do hope that the markets try to gather themselves as we head into the midterm elections this fall. That does often happen, but again, I'm making the assumption that any rally we get between now and the fall will be short-lived, and we'll still have more pain to suffer through after the election is over. So let's keep our eye on the prize and remind ourselves not to blow up our accounts along the way. As long as we can survive this storm that we're all dealing with right now, we'll be in better shape to tackle whatever bull market emerges from the ashes a year or so down the road. But today was another friendly reminder that, after what felt like a better market here in the last week and a half or so, those things can be quite fleeting. For many years, we've had the good fortune of seeing a market that felt like it was two steps up and one step down. Now we're in the opposite It kind of feels more like we're in that mode of 2 steps down and 1 step up every so often, but you should approach those steps back up with some hesitancy because chances are that the gravity will push that market back to the downside again. You can see that it was an overwhelming victory today for the bears. There weren't very many green boxes on the chart here in front of us. We had Qualcomm with some good news as it was kind of partnering up with, I think, Apple on a news story with some of its modems. So it was up 3.5% today. United Healthcare and Anthem, a couple of health insurance companies. They don't exactly scream growth, but they're kind of the place to hunker down occasionally. They were both up fractionally here today. We did have Morgan Stanley that was up about 1% today, but truth be told, it looked a lot better earlier in the day. Those of you that follow me on Twitter know that I was a very busy boy yesterday afternoon, because I like to distribute information regarding dividend increases, and usually they come just dribbling in here or there. But last night was an exception to the rule because of the bank stress tests and CCAR results. The banks have an additional layer of complication when it comes to their dividend policies because they have to get the okay from regulators in order to do that. So last night I probably posted about 10 different banks that were coming through with various dividend announcements. So if you're not following me on Twitter, make sure you go check out my feed if you're interested in some of those announcements. But Morgan Stanley was one of the nicer increases. I think it was like 11% dividend increase in addition to a big buyback program that they announced. Goldman Sachs also had a huge dividend increase announcement of 25%, yet that didn't even bail the stock out today. It was up very nicely this morning first thing, but gave back all of those initial gains from that announcement and actually closed lower by 0.43%. So what appeared to be a really strong morning for many of those financials and banks gave way to selling just like the rest of the market, regardless of all the excellent dividend news that might have been mentioned yesterday. There was some nice movement out of the casinos. Las Vegas Sands and then Wynn were both up about 3 or 4%. And the reason behind that is China is starting to kind of open up once again. In fact, I heard Shanghai Disney will be opening its doors here in a few days as well. So as China kind of moves past their lockdown, some of those companies that benefit most directly from China are going to maybe get some bounce in their stock here. And Las Vegas Sands and Wynn Resorts are both huge Chinese players. I know it probably doesn't seem like that to some of you here in the United States, but I can confirm it is true. I've actually been to both of their casinos there in Macau, not too far away from Hong Kong. So they are largely driven by the Asian gaming markets these days. And so that was strong news for them for once, because remember, they've been getting beaten up in recent months and years as a result of all the controversy with coronavirus and the health pandemic. That's the type of thing that is the real enemy of casinos out there. Now, you will notice that there is one bright green patch involved here from a sector perspective, and that is energy. You can see that Exxon was up about 2.77%. We had Conoco up 3.24%. And a number of these others were up as well. We actually talked about the energy sector in my dividend growth investing class today and purchased a stock and managed to end the day with some small wins in that particular stock. And one other thing I would mention about that, especially for those of you who are newer premium members of Market Scholars, some of you might have taken advantage of our 222 sale as an example. We actually just started a brand new dividend growth investing portfolio today that we will build out between now and the end of December. So if you were somebody that wanted to start at day number 1 from that portfolio building process, then you might want to check out my recording from that class here today if you weren't there live, since you wouldn't have been part of the portfolio building process from the start here in this last portfolio that we would have started in January before some of you would have joined us. So just a quick heads up to to those of you who are premium members hoping to build a dividend growth investing portfolio right alongside our class. But it was nice to see at least some snap back there in the energy space. Remember, energy has been hit quite hard here in the last 2 or 3 weeks, and a lot of once really strong looking trends from a charting perspective have really slipped dramatically in that space. So maybe things got a little bit overdone to the downside in recent weeks, and maybe this is their opportunity to try to stabilize, many of them stabilizing right around their 50-day moving averages or what have you. So keep your eye on that possibility. But other than that, there wasn't a whole lot of green out there. Pretty much red across the board beside those key areas. And that includes all of our mega cap players, like Alphabet and Amazon. Amazon was down 5% today. Tesla was down 5% today. I heard it was Elon Musk's 51st birthday, so happy birthday to Elon. I'm sure he's not listening, but nonetheless, it looks like Tesla struggled on his birthday today. Nike was down significantly, down 7%. Now that was due to their own earnings announcement that they came out with. Home Depot and Lowe's both struggled today, about 4 or 5% to the downside. Remember, the home building market has been one of this market's real nightmares this year, with the expectation that rising mortgage rates are really going to crash the housing market, and what that might mean for stocks like Home Depot and Lowe's. And then as we kind of drift our attention off to the left-hand side here, you can see our mega cap tech stocks all suffered today as well, where you had Microsoft down 3%. You had Apple down nearly 3%. We'll actually be talking about that stock a little bit later on in tonight's video. We had Nvidia down 5% today. Visa was down 2.6%. And a lot of those semiconductor companies, with the exception of Qualcomm, all down here today. So ugly, ugly day. Pretty much everything outside of energy really struggled here today. Let's go ahead and take a look at our breadth measures now. And as we've got our visualize tab pulled up here, I've got the S&P 500 as our index that we've selected. And as you can see, in terms of the advancers versus decliners, we had 65 advancers here within the S&P 500 today, which means that's only about 13% of the index managed to close in the green. And as you saw just a moment ago, the vast majority of that 13% was in one single sector, energy. Outside of energy, there was extreme lack of positive activity. It was an overwhelming day there for the bears. As you can see, 437 companies closing in the red here today. Let's go ahead and pop on over here to the charts now. And wanted to bring this up because I had heard something on business television earlier today and just kind of wanted to see how it looked visually. What I've done here on chart 6D, for those of you that are premium members following along at home, I've gone in and I've changed the time period up above by clicking into that drop down right there of the time frame setup and then clicking on the time frame submenu. And I've changed this to a time interval of 20 years and an aggregation period of quarters. So, every 3 months basically is the way that you would think about that. But anyway, somebody on television earlier today mentioned that it's been a long time since we've actually had 2 quarters in a row to the downside, and they were absolutely right. Now, keep in mind there's still 2 more days, so maybe if cancer gets cured or something, maybe there's a miracle that pushes this all the way to positive gains in the next 2 days. But I'd be willing to bet nearly anything that does not happen. As you can see, this is a very ugly, nasty down candle that is likely to stay red in the next 2 days. You're not going to offset 3 months worth of losses in just 2 days. So let's call it what it is. This is basically as official as it's going to get when we say that this will be the second straight down quarter for the S&P 500. And the last time that happened, believe it or not, you'd have to go all the way back here to 2015. And that occurred here during the second and third quarters of that particular time period. And you can see that those 2 candles were actually quite modest compared to these more aggressive candles that we have over here. If you go a little bit further back from 2015, you'll also find that we had 2 quarters in a row to the downside back here in 2011. So that was the same, second and third quarter time period. I remember that fall quite well because those of you that knew David and I at the prior company we worked for over at TD Ameritrade InvestTools, I had just started at InvestTools. I was working with TD Ameritrade at their headquarters in Omaha for a few years prior to that, but I moved out to Utah to start in their education business in 2011, and later on that summer things just went wacky, and that was when the U.S. lost its credit rating, its AAA credit rating, and all kinds of chaos was taking place. So that one was a little bit more aggressive than this one back here in 2015, but still nothing even close to what we're experiencing right now. If you go back even further, you then see this is what more of a typical actual bear market environment would look like. Take a look at here. In 2007, we started off what would have been considered a very awful experience for investors at that time. I should know because I was an investor at that time, and it was not fun. And at that particular time, whether we knew it or not, we were about to embark on a very ugly journey to the downside. We had 1, 2, 3, 4, 5, 6 quarters to the downside. That's not 6 months, that's 6 quarters. So that is your 18 months that I was referring to before. And so if you think about it from that perspective, if we've gone through 2 quarters right now and we have something like that on the horizon, again, there's no guarantee that that's going to happen exactly, but if we kind of use that as a typical base case there, we could still, end up having 4 more quarters or an entire calendar year in front of us of difficult market environments. So brace yourself for that possibility. But that is kind of unique that we are now suffering through our second quarter in a row to the downside, which does not happen all that often throughout history. Now, if I were looking at this with a fresh set of eyes, I'll just be honest and I'll say the anomaly is really the opposite. What we're experiencing right now seems like that should be typical market behavior given enough data points throughout history. I think the more strange thing about this chart is the lack of 2 in a row quarters to the downside. I think the strange thing about this chart is all of these quarters in a row that close with positive gains, right? Before this 2-quarter down move that we had 1, 2, 3, 4, 5, 6, 7 straight quarters in a row to the upside. And you had another huge streak over here of 1, 2, 3, 4, 5, 6, 7, 8, 9 quarters to the upside right there. You had another huge streak here of 1, 2, 3, 4, 5, 6, 7, 8, 9 quarters in a row there. That is not normal behavior, at least the way that I originally learned about the stock market. I never made the assumption when I started learning about the stock market 20-some years ago that stocks only went in one direction. But I think a lot of people who have just started investing here in the last decade or so, whether they know it or not, they've been kind of subliminally trained to assume that stocks just go up. And when you have 9 quarters in a row, remember that's over 2 calendar years in a row without a down quarter, your mind is getting trained that it's easy and that the road to riches is directly in front of you and you just have to stay on the path. But the truth of the matter is we have difficulties as investors, just like we have difficulties as humans in life, and we have to deal with those challenges the best that we see fit. And having a strong education and an ability to pivot when necessary, change strategies when necessary, all that kind of stuff can kind of keep you in the game. So we're struggling right now. You don't need me to tell you that, but I did find that kind of interesting here that this will be the second straight quarter to the downside, which does not happen all that often. Let's take a look at our normal view now. Typically what we would use on this is the 1 year, 1 day setup. And I usually like to bring this up whenever we have a big day to the upside or to the downside, just to give you a sense of what does volatility look like at any given moment in time, because this is a more interesting visual aspect. What you're seeing here in the middle is basically a graph that will show you through the spikes of the green up and the red down how aggressive the days have been and whether they've been considered quiet days or whether they've been wild days. And, I've been trying to stress this often in the last let's call it 6 months or so, and so I fear that I sound like a broken record, but it's because we always get new people watching these videos, as well as me wanting to kind of pound that information home in the back of those of you who are loyal listeners, because it's important to understand that what we're dealing with right now is a heightened volatility environment. It's not the most extreme thing that we've ever seen. The VIX right now is at 28, but in terms of the whipsaws back and forth day after day after day, it is kind of more aggressive, and it kind of wears you down as an investor, as a trader. Just when you think you're getting this nice upward swing here, right? Some of you might have been thinking, well, we're off to the races now. And again, I was very upfront with you that was not my expectations, and I could be wrong, by the way. We're not down back to those lows yet, so I could very well still be wrong at this point. But there's a reason I told you last week that my expectation was not that we are off to the races, and it's like the reason is for days like today. Because if all of a sudden your mindset is that was the low and now we're off to the races, then this type of a day could be devastating to you when we're down 2%. But to me, it wasn't particularly devastating because that's how I'm setting up my mind to make the assumption in terms of how I'm handling things in my portfolios and what have you. So anyway, I hate being the bearer of bad news because I always appreciate it when the market goes up more than when it goes down personally as a long-term investor. But I always try to be truthful and objective in my analysis with you guys as well, and I'm just not seeing that right now. What I see is a path of least resistance that continues to go to the downside, and you have to be very careful as far as how you're positioning yourself. You have to make sure you're going into safer investments. You have to make sure that you are weeding yourself off the leverage if you were there in the first place, and being more rational about how you're approaching the markets when they are in a foul mood like they are at this moment in time. So today was one of those 2% down days, which pushes that red line down here to the orange horizontal line, which is the 2% price move. Last time we had one of those to the downside would have been here on June 16th, right near the lows where we established it the very next morning. So it's been a couple of weeks at this point since we've had a day like this, and maybe a little bit more jolting to some of you as a result of that. But the truth of the matter is, when you look at this, it is more par for the course. We've had tons of 2% down days in just the last 6 months. We've had way more during this 6-month period than we had in the vast majority of 6-month periods, with the exception of COVID, in the last decade. That COVID time period was also very chaotic. But other than that, what you're looking at and what you're living through right now is one of the more aggressive trading environments that you will ever find yourself in. So if you're on the brink of giving up, hang in there. Some of the folks who are not listening right now have already given up. That's their issue to deal with. But I want the vast majority of you to hang tight. I want you to survive, because remember, the stock market is a wealth generation machine, but some people don't stick around long enough to benefit from that. And a lot of times the reason for that is because they get blown up in really hard markets like we're in right now. So do whatever you can to batten down the hatches and make sure that you survive the difficult storm that we are in the midst of here currently. Let's go ahead and now take a look at our foregrid. And this will give us a sense of posture using the market forecast technical indicator. This is chart 4B for those of you that are following along at home. Today was a more aggressive trading day. You can see that the labels that talk about the daily range are orange on all 4 of these charts. And what that means is that today's range was more aggressive than the average true range. And so basically just a way to judge whether the high to low movement within the market was larger or smaller on any given day. Today was one of those larger days. And you can see from the charts in front of us that we closed either at or very, very close to the lows on the vast majority of these 4 indices as well. The S&P 500 closed at 38.21, and the low was 38.20. So we're basically 1 point off the low. And it looks like the NASDAQ was awfully close to the same type of thing. We closed at 11,181. The low was 11,177. So just 3 or 4 points away from the low. And then the Russell also looks like it closed nearly at its low. It closed at 1,738. And its low was 1,738. So the Russell 2000 did close at its low. The other two were basically fractionally off of it. And then the Dow had just a tiniest little wick there at the bottom. So it seemed to close maybe a little bit more off its low, but still a very ugly red filled in candle there. Remember, when the candles are filled in red, basically what that means is that the open was high and it closed low, or in this case, near the lows of the entire session. So basically it fills the candle in that whole way lower. And you can see that once you get some of those candles that are fully filled in red, it kind of starts almost in a domino fashion, start working against the investor that's out there. So you got to be more careful around those as well. The other thing that I didn't really like about today's action, there was plenty to choose from, of course, but one thing I really did not like to see is this is where you would assume resistance would be, right? How many times have we worked with you guys over the years to help you understand the importance of the 30-day moving average? And when the 30-day moving average is broken to the downside, you assume that it becomes resistance, right? Whereas when the market is trending higher, you assume the 30-day moving average will act as support and the market will bounce up and off of it. Well, that's the problem with where we stand right now. We had all of these nice oversold areas here. Remember, we talked about not only the oversold daily cluster on the S&P 500, but also we had the second oversold weekly cluster in 10 whole years during that exact same time period as well. So should have we been surprised that we had some sort of a reversion to the mean? Of course not. Those were extreme oversold conditions, and so we needed to relieve those oversold conditions. The market needed to catch its breath, and that's what it did. It bounced back towards that falling 30-day moving average. But both yesterday and today did not do you any favors if you were hoping that we were going to establish that as the new low going forward, because what you're hoping to see is that we slice straight through that moving average and start establishing higher lows and eventually higher highs. But if you only go back up to that falling moving average, then use it as a launch pad to bounce down and away from it like it looks like is happening in the last 2 days, then you're still in that prior trend of lower highs and lower lows. And that does not bode too well. Obviously, a trend is your friend until the end. And right now, the trend is decidedly bearish, regardless of what you've seen in the last week and a half off of the bounce off the extreme oversold conditions there. Even this time back here, when it went up to the moving average, it was able to get through there. It didn't stop exactly at the moving average, right? It went through there on day one, and it kind of held that level for the next week or so. So in this regard, it was even more kind of pathetic in terms of how it handled it by going up to the moving average, refusing to go through it, and now just 1 day later appearing like it's bouncing down and away from it. And it's not just the S&P 500. You largely see that on the other indices there as well. They're all set up kind of the same way. Notice that the moving average colors, so the tip of the 30-day moving average is red in all 4 of these charts cases. Yesterday it was not for the NASDAQ and for the Russell 2000, but today with the big sell-off, what that signifies is prices below a falling moving average. So yesterday the moving average was slightly tilted higher on the NASDAQ and slightly tilted higher on the Russell 2000, but remember the 30-day moving average is basically a rolling indicator, and every day you have to lop off the 30th day way back and then add the newest day. And with today being an aggressive down day for these indices, it had enough of an impact on the calculations to bend that moving average back down once again. That's not a great sign. The other thing that I would mention is that we do still have the market forecast green line with bullish postures. How long that lasts, we'll all find out together. But if we have another day or two of selling in front of us, it's probably not going to last very long. And the reason I say that is as you kind of eyeball the green line, let me do this. Let me right click and maximize the sell. And I just want to show you, I guess it doesn't look so bad here. It looked more flat to me when they were all kind of scrunched together looking at the foregrid. This isn't looking as flat now that I kind of expand it out on a maximized sell. But the point being, the background color of the chart is light green. What that signifies is that according to the market forecast, intermediate posture is weakly bullish. And that's happening because the green line has emerged out of the lower reversal zone and has started to work its way higher. But because it's not yet above the 50th percentile, it's at 37, we only consider it weakly bullish, not strongly bullish. And you can see that right over here, when you had all these days in a row to the upside after getting that oversold cluster signal, you had a pretty rapid ascent in that green intermediate line on the market forecast. But notice there's been a little bit of a change here in the last couple days. When we've got these sell-off days up above, the upward ascent of that green line has slowed considerably. And so if there's a few more sell-off days in front of us, there's a very real possibility that we would go back to a strongly bearish posture on that green line, because remember, it would already be below the 50th percentile, again, making that assumption that it happens in the short term. So put that in the back of your mind. We're not there yet, but given what we've seen here in the last couple days, it really would not take much to have that happen. The other thing that I should mention is that technically we do have what's known as a bullish intermediate confirmation signal. And that occurs when the green line is positioned bullishly and the red line is in the lower reversal zone. Now, as you've heard us mention countless times throughout the years, there are better signals and worse signals. And a couple of the ways that we try to determine that is, one of the ways is looking at where the red line is positioned. And if it's down below 5, we sometimes view that as not ideal because it's telling us how strong the bearishness is at that moment in time. Because as you know, the red line can be anywhere between 5 and 20 when it's in the lower reversal zone. And when you're in a more healthy environment, you see the red line kind of in that 5 to 15 kind of a zone. Like over here, the red line was right here where I'm circling with my mouse, and it was at 14 or 15 at that moment in time. So we actually prefer that if you're going to take a bullish trade based off of the bullish intermediate confirmation signal. This type of a move suggests that the bears are a little bit too overwhelming, and if you're lucky enough to get a bounce off of the bullish intermediate confirmation signal, it's probably not going to last all that long. And that kind of jives with my overall sentiment about the markets right now anyway, which is I don't really trust this market any more than I can throw it. So you have to be quite agile if you're going to survive. And right now it's not something that I would want to say, oh, well, here's a great setup for a trend trade for the next several months because this signal told me it was a buy the dips opportunity. That is not how I'm thinking about these markets right now. So that is one way to identify that it is not an ideal signal, even though the signal exists. The blue line is another way that we try to judge whether it's a more ideal signal or not. And the blue line is actually positioned kind of where we want it, which is it's pulled back enough on a weekly basis where this is a more legitimate buy the dip kind of a mindset. Because sometimes what happens is we get these signals, but the stock or the index is only down like 0.5%. And it's kind of like, you're really going to call that 0.5% a buy the dips moment, right? But in this case, this is actually a pretty healthy midterm or near-term pullback, with us being down 2% here today. But I would also mention that many of you probably only want to take action on the bullish intermediate confirmation signal when the green line is in a more strong position, right? This is a bullish posture, but again, I must reiterate, we would call it weakly bullish. So some of you might only be interested in taking the bullish intermediate confirmation signals when the green line is above 50 and rising at a minimum, or some of you might say, I need the green line in the upper reversal zone. Remember, all three of those instances do push or point to a bullish intermediate posture, but the other two would be considered much more substantial. This one is still real iffy. There's a big question mark around it because we're still below a falling moving average. And so you're kind of jumping the gun saying, hey, the markets are starting to get slightly better posture again. But truthfully, path of least resistance at this moment in time, continues to be the downside. So you kind of have to tread more cautiously there. So S&P 500 was down 2.01% today. The Dow Jones was down 1.56% today. It's got the same type of a setup with the bullish intermediate confirmation signal, but not considered an ideal setup because the red line is at an extreme reading below 5. In fact, below 1. All of these are below 1. You had to get into the fractions on the red lines on all four of these indices here today. You basically closed as close to 0 as you could. And so all these others, same thing. You've got bullish intermediate confirmation signals on all four of these charts right now, but none of them would be considered ideal candidates for a true buy the dips mentality because of how extremely low the red momentum line is. So we're kind of in the same position with all of these. We had an extreme day with a large daily range. We have the path of least resistance continuing to be to the downside with red moving averages suggesting prices below a falling 30-day moving average. You had all four of these closing basically at or very near their daily lows. And really the only benefit you have going for you right now on the bullish side of the equation is that you're still barely clinging on to a weekly bullish intermediate posture. Let's go ahead and step away here to the internet. I always like to get a chance to say thank you to those of you that help support this free video that you're listening to right now. So let's check the stats. And last time I did the video there on Thursday, it looks like 109 of you stepped up to the plate to help support this project. And as I always say, as long as we're up and over 100 likes, I'll be happy to deliver a full-length video for you the next time I do the video. Remember, I do it on Tuesdays and Thursdays, so I'll offer you the same setup this coming week as I always do. If you guys can click like for me enough, up and over 100, I'll be happy to do another full-length video for you when I'm scheduled to do it on Thursday, which will include a trade application example. However, if you prefer the shorter form videos and you just want a quick little 15-minute recap of just the indices and not with all the extra charts, then don't click like, because if we're under 100 likes there on Twitter, I'll just do a very quick video there for you that day. So some of you like the longer videos, some of you prefer the shorter ones. We'll kind of let the crowd vote, so to speak, in that regard. But thank you to those 109 of you that did help support us. Remember, these videos take a minimum of 3 hours out of David and I's day, and we don't make a cent doing them. They are all completely free of charge to you guys. So if you want to help us or say thanks, the best way for you to do that is click like for us there on Twitter. As I mentioned before, I taught my dividend growth investing class earlier today. That has now been posted to the Trading Rooms tab up at the top. And since today was the first day of our 25 stock journey between now and the end of December, some of you who want to kind of follow our progress from the beginning will want to maybe watch that video that I had earlier today for my premium members. David did teach his directional options strategies class as well. And then tomorrow I've got factor-based swing trading first thing in the morning, and then David will be doing his options inventory trading in the afternoon. Let's also take a look here at the sector selector information. Last week was one of the biggest shakeups in terms of rankings that we have seen in quite some time. In fact, there was only one sector that held its position from the prior week, and that was real estate. Real estate stayed exactly at number 10. It's been there the last 3 weeks. But every other sector did see movement. And the big talking point was energy. This was actually the first week of the entire year that energy was not ranked number 1 on our scoring system. We use a proprietary scoring system here called the WAR score, which stands for weighted aggregate returns, where we're taking return time periods from multiple, look back periods like 1 month, 3 month, 6 months, etc. And then we're aggregating them together, and then we're weighting them more heavily with the nearer term time periods. And this was the very first week in all of 2022 when energy was not ranked number one. It actually went to its number one position just by sheer coincidence the very first week of January. In the final week of December last year, it was not number one, but just so happened that when the calendar turned, energy went to number one, and it did not relinquish its number one position until this week. And again, that should make sense given what we've seen with a lot of those oil and gas stocks in the last couple of weeks. They've tumbled pretty aggressively. For a while, they had such a head start that even when they would sell off, they would still be number one on a ranking system. But because they sold off many days in a row and the rest of the market was rebounding at the same time, that opened up the door for them to give up that number one position. So consumer staples made their way into the number one position, obviously for the first time this year, since this is the only other sector that has had a number one position all of 2022. We'll see how long that lasts up there. But remember, consumer staples tend to benefit from more defensive characteristics. And so when markets are ugly like they were today, and like we've seen so often this year, a lot of times investors try to hunker down in brand name companies like Coca-Cola or Pepsi or Procter & Gamble or what have you, those types of companies. We did see a big tumble, by the way, in materials as well. Materials fell all the way from number 4 down to number 9. So it was not just an oil story. And remember, when I was last with you guys on Thursday, I spent a considerable portion of that presentation focusing on the commodities area, which was somewhat atypical. I chose to go through the commodities 12 grid that particular night instead of the traditional asset class 12 grid for that reason, to point out how bad the selling had been in commodities. And it was not just energy. Remember, we talked about silver and palladium, and then we talked about corn and wheat. And so that materials sector is where you're going to find a lot of those like fertilizer companies for agriculture. It's also where you're going to find your steel manufacturers and your iron ore producers and miners and all that kind of stuff. So it makes sense when commodities fall out of favor, the two areas that tumble the most are going to be your energy and materials sector, and that is what we've witnessed here in recent weeks. All right, let's go ahead and pop back on over here now to our 12 grids, and let's start off with chart 5A, our asset class 12 grid. As we're looking at this, a reminder that the background colors of these miniature 12 grid charts are either going to be pink or green, and when they're pink, that means we have a bearish market forecast intermediate posture, and when they're green, it means that we have a bullish market forecast intermediate posture. And so we have more pink charts right now than green ones, but maybe we'll start with the chart in the lower left-hand corner because to my eye, that looks to be probably the best looking chart, at least among those that are green at this moment in time, and that is the US dollar. The US dollar actually had a pretty solid day today. It was up 0.58%, which is a pretty strong move for such a large currency, especially against a basket of other currencies like this UUP is set up with. But point being, we did have a bounce higher after having a bit of a pullback, right? We've kind of been in a weird mode here with the US dollar where it's largely been strong this year, but we did have that possibility set up where we were looking at those two areas as maybe being a double top area. And that's still in question, right? It might be. We'll only find out as history rolls along here. But what we do know at this moment in time is that after hitting that second top, we had a pullback to the moving average, and then we had a pretty aggressive bounce day here today. That bounce day was enough to give you a strongly bullish posture. Notice the background color is dark green, and it's the only one on the board that has that. But one kind of little fly in the ointment that I'll point out is that the moving average is yellow. And what that signifies in this case is that the moving average is going down slightly at a time when the price of the security is above it. So we have kind of conflicting information right there. It's kind of flattening out because it needs to incorporate the last 30 days worth of data, which is going to include those double top areas, but also include these lower areas. So we're kind of just flatlining a little bit at this moment in time. But obviously, if the bounce continues from what we started today on the US dollar, there's a pretty decent chance that that moving average will start bending higher once again and kind of revert back to green like we've seen it so often this year. So this has been a consistent theme. This should shock nobody. The US dollar has been, one of the few places that have benefited in calendar year 2022. Another area that has largely benefited for most of the time this year is the chart in the other corner in the bottom, and that is the 10-year U.S. Treasury yield. Now, the yields were actually up a little bit here today. We closed at 3.2. We were actually having a good conversation about this in my Thursday question and answer session that, as I mentioned to you guys last week, lasted over 5 hours. Now remember, that's normally not going to happen. And the reason is usually I need to relinquish the WebEx platform for David's class later on Thursday afternoon. But it just so happened David was out of the office on Thursday, so it allowed me to have an extra long class if I wanted it. But one of the things we discussed during that 5-hour marathon is how quickly the Treasury yields had fallen in the previous week. Well, just like that, it feels like the snap of the fingers. We've gone from basically having a Treasury yield under 3% briefly just 3 or 4 days ago to now being all the way back up to 3.2 again, and that is considered quite high. So, it probably is not going to take much from this point going forward to flip this posture back to green. Right now, it's not quite there, which is actually kind of surprising to me. Usually, when you have an upward trending chart like this and you have 3 days in a row to the upside, it's going to be enough to bend that green line on the market forecast a little bit higher, but it's just not quite there yet. So I'd venture to guess if we're up again tomorrow and the next day that we will be back to a strongly bullish posture. Remember, with the intermediate reading at 57 right now, currently it's falling, which is why we have the light pink background color. But if that would go from falling to rising, that would be in the strongly bullish territory because it's above the 50th percentile. So that would be my expectations right now, all else being equal, because this is one of those charts that every time you've denied it, it's come roaring back. Speaking of which, oil, just to the left of it. Oil's had a very strong 3-day rally here. Now, where it stands is it's still just a touch below its 30-day moving average. So I know that because the moving average is rising and it's yellow, so that means price closed just a hair below it. But it is right there. If oil rises again tomorrow, it's likely to change that moving average color back to green. Notice the difference in the intermediate reading on oil versus the 10-year Treasury yield. Oil's is at 34.09 and falling. So if oil is up again tomorrow, again, that'll be its 4th day in a row, and those are some pretty big moves. The problem is the moves down were equally as violent to the downside. But if we were to switch from falling to rising here, this one would only be weekly bullish. And that's a little bit of a change of pace. More times than not, when you've been listening to these videos this year, oil has had a strongly bullish posture. So even if this will be viewed through the lens of history as being some sort of a stopping of the bleeding, so to speak here, 4 days ago for oil, it will have kind of distorted the chart in such a way where there was actually broken support levels there. And then that calls into question whether it can get back to its old highs again. And that's kind of my thought right now. We've been trained this year to give oil the benefit of the doubt because every other time it's pulled back, it's been a pullback worth buying and it eventually went to new yearly highs. This time has felt a bit different. It's been more violent to the downside. It's cut below the moving average much more aggressively. And even if it does go back to a weekly bullish posture here soon, you've already exerted quite a bit of energy just getting off of those lows in the last week. What are the chances it's got enough gas in the tank, pardon the pun, on this oil ETF here to get actually back to that high again very quickly. I'm not saying it can't happen, because remember, commodities do move very violently. If there was, a new war that broke out in the Middle East or something like that, oil prices would just go flying to the upside. So, with the exception of some sort of big news announcement, just from a technical analysis perspective, it does make you wonder if it's going to have the energy this time to get back to those new multi-month, multi-year highs the way it did so often back here, because you cut so aggressively lower this time compared to what you had done in the previous sell-offs. Gold does not look all that good. So similar to oil, it does have a strongly bearish posture. Of the two, I think oil still looks better. Gold just cannot get out of its own way. It has been stuck in a rut for months at this point, right? We keep on waiting for it to, wake up from its slumber, and it just refuses to do it. In fact, it gives you the impression that it continues to lean lower and lower and lower. So we're still stuck in that mode. Gold was actually down today, down 0.16%, perhaps partially due to the rising dollar, but that didn't seem to stop oil prices from going up nicely. Nonetheless, you can see that most of our other charts do have a downward tilt to them. Now, 3 of those downward tilts do come associated with a light green background color, and that's your preferred stocks, your foreign bonds, and your long-term treasuries. So they're basically saying they're planting the seeds of a potential rebound, but there's not enough evidence to suggest whether that seed is going to die in the ground or whether it's going to sprout to become a strong tree. I was actually reading on Apple News here today about a Chilean tree that is 5,000 years old, and going back and forth with a tree in California as to whether it's the world's oldest tree or not. But anyway, whenever we're planting seeds out there, we don't know. Is it going to be a great harvest, or are we going to have locusts come and eat the harvest, right? And so you can kind of think about that light green background color as saying you've now planted your crop, and now you've got to kind of wait to see if it's actually going to turn into anything or whether it's going to be a wasted crop. So we're in kind of that transition possibility right now, even though the transition hasn't actually happened. The other charts that are all trending lower, including foreign developed stocks, foreign emerging stocks, high yield bonds, and Bitcoin, they're all still trending lower, and they're associated with a strongly bearish posture. And none of them look particularly good. Now be aware, EEM has kind of been more intriguing to me here lately, because I've seen a lot of relative outperformance and relative strength out of Chinese companies. And notice how EEM is still trading close to its 30-day moving average, whereas developed foreign stocks have that huge gap between those two right now. So of the two, I think that emerging markets stand a better chance of establishing some bullishness going forward. But even that might be a difficult thing to accomplish, considering the path of least resistance for most stock markets around the globe right now continues to be to the downside. So not exactly easy there. And then again, this was a risk off day to confirm that high yield bonds really struggled compared to other bonds. Long-term treasuries were actually up a touch today. Foreign bonds were just down just barely, but high yield bonds were down pretty aggressively. That's a pretty ugly day, as you can see by the size of that candle there, down over 1%. And then Bitcoin also sold off today, which is fairly typical of it on a risk-off type of a day like this. So Bitcoin finds itself at around 20,000 at this moment in time. Let's take a look at the sectors here. And as I mentioned before, really the only outperformer here today was energy. You'll see that energy was up 2.7% here today, which is actually a pretty strong day. And it would have been stronger, by the way, if the whole stock market wouldn't have just fallen on its face, because you can see even energy was trading higher at one point during the day. But there was just too much selling pressure across the board. It was not able to close at its highs. Nonetheless, the fact that it eked out a gain today is worth mentioning, because out of these 11 different sectors, only energy was in the green, and it was actually in the green quite a bit. 2.7%. So it wasn't like, hey, it just barely got its head above the break-even line. This was actually a pretty strong day for those oil and gas companies. Remember, they put in their very first oversold cluster signal of the entire calendar year here just 4 days ago. We talked about that in my video last week. So maybe not a huge surprise to see that the market has sent it higher for 3 straight days after having such a rare signal in that particular case. All of the other sectors were lower here today. It appears that the worst offender was consumer discretionary. Now remember, this is the market cap weighted version of it, so it is heavily influenced by Tesla, by Amazon, and by Home Depot. And remember when we were going through our S&P 500 heat map at the beginning of tonight's video, all 3 of those were down significantly today. So no surprise that the consumer discretionary XLY ETF also suffered as a result of that. Technology also had a very difficult day. It was down 3% today, and that was when we were talking about NVIDIA and Microsoft and Apple. And that seems like a good enough segue to roll into our trade application example. So let me go ahead and pull up chart 3A, and this time I don't even have to change the ticker symbol. Most of you who are premium members know that we have to have a default ticker symbol for each one of our charts, and so we pull up the chart and then we have to change the ticker symbol to whatever we're going to be trading. Well, it just so happens that the default ticker symbol for chart 3A is Apple, and that was the trade that I did here in tonight's video officially, so I don't have to change anything in this particular case. And remember that we do these videos while we do these trades while the market is open. And once we get our fill prices and all that kind of stuff, we immediately send that information out as a trade alert to all of you who are premium members of Market Scholars. So that way you get a slight benefit over those that are just watching the video for free. Not that that always works, right? Sometimes it works against you, but in some cases it's a benefit. And at least you have the information at your fingertips, so that way you can make that decision, either yay or nay, once you get those trade ideas sent out by David and I. But anyway, in this trade application example here for this paper money account, what I did was what's known as a bear call spread. And in this case, I did it a little bit differently than what you guys are used to seeing out of me. And the reason for that is, like a lot of stocks, Apple is going to have their earnings coming up here in the next month or so. And so normally we're now kind of in that period of time where the August monthly contracts are about 50 days away. And normally that's what I'd be focusing my attention on. But if I did that, it would require me to hold through an earnings announcement, and that could very well upend my trade. Now, it could also help my trade. But the point is, it's a crapshoot because you have no idea how the market's going to react when a company reports its earnings. So today was a rare day where I actually did a bear call spread with, I think it was only 17 days until expiration, because I did the July contracts. So the July monthly contracts will expire prior to Apple reporting its earnings. And so that required me to have maybe a tighter amount of space before I get in trouble with the trade, right? The longer you go out in time to sell, the greater web or net that you're casting out there of you having places to be wrong. But when you have fewer amount of days to be in the trade, you have a reasonably tighter range where you can't be too wrong, otherwise you're going to end up losing money on the trade. So what I did, I believe, was the 144, 145 bear call spread. Again, feel free to check the Telegram app if you're a premium member for the fill details and the strike prices and all of that. But that would put me at approximately right up in this general range that I'm kind of circling right now with my mouse, which basically would kind of take us into that congestion zone that we had back here during this time period at the beginning of June. So again, admittedly, this is a little tighter than I would normally prefer, but the upshot of that is I only have to be in this trade for a couple of weeks. And if this rolling over of Apple leads to further selling, I should be in good shape. And that was what kind of drew me to this chart. Now, I will tell you there were a lot of stocks that look like this. So, Apple being the most liquid, it allows for me to do trades very easily on it. But again, a reminder that that's the way that the S&P 500 looks, right? We're bouncing down and away from that falling 30-day moving average. And so that basically means that many stocks that make up the S&P 500 are doing the same thing right now. And notice it was a strong enough sell-off here today where our near-term posture went from being bullish, where that blue background color was on the chart, to now being bearish with the rolling over of that blue line now painting the background of the chart pink there for us. And you'll also notice that Apple remains a market underperformer, right? That hasn't happened all that much over the last decade, as Apple has been one of the superstars to the upside. But you will see the S&P 500's dotted line is above Apple's price candles. So this is actually an underperforming security here more recently. And sometimes when you're doing bearish trades like this one, you try to kick them while they're down. So for those of you that are not all that well versed in options trading, effectively what I'm doing here is I'm placing a bet where I don't want Apple to go above $145 or whatever it is between now and the third week of July, and I collect a credit up front, and that credit is mine to keep as long as that does not occur. And that could help by either having the stock go sideways, going lower, or it could even drift up a couple bucks as long as it doesn't go above 144 or 145. And in all those cases, I would be a winner with this trade setup. Where I would be a loser is if it blasts higher. Let's say this is just a head fake. It's got everybody on their heels saying, boy, here we go again. Another sell-off is on the horizon, and then for whatever reason, stocks just erupt higher. Well, in that case, because I'm doing a bear call spread, there are two strikes involved. One of them is the sold strike, which drives the profits of my trade. The bought strike is there as kind of a hedge that is embedded within the trade, so that way I don't lose too much money in the event that I'm wrong. If the stock were to rip up, I would still lose some money, but my losses would be capped as a result of having that embedded within the trade. Okay, so that's what I had for you here tonight. I hope you enjoyed the presentation. If you did, I have one simple request for you. It doesn't cost you any money, and all it takes is 5 seconds out of your day. Just click like for me there on Twitter. Remember, you can do that either directly on Twitter, where it will be pinned to the top of my timeline, or you can do it directly on our website in that little Twitter widget below the video like I showed you before. Okay? If we're up and over 100 likes, I'll be happy to do a full-length video again for you on Thursday. If we're below 100 likes, I'll just do a quick 15-minute video. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.